People fear crypto because of its volatility. But here's the reality. With the right strategy and 10 simple rules, it's one of the hardest markets to actually lose in. Stick with me and I'll explain why. Welcome back to Durian Finance. Today I'll share 10 key principles that can help you survive crypto's crazy volatility and maybe even come out ahead when everyone else panics. Don't just buy because someone hyped it up on X or YouTube. Dig deeper. Study the project's white paper. Understand its real-world use case and research the team behind it. Check if credible institutions are backing it. Look at the strength of its community and see if there's any government recognition or regulatory support. On top of that, monitor on-chain activity. Are people actually using it or is it just hype? If you don't understand these fundamentals, you won't have conviction to hold when the market crashes. Never, ever gamble your rent, your mortgage, or your children's tuition fees in crypto. That's the fastest way to destroy both your finances and your mental health. Instead, only invest with surplus money, funds that won't affect your lifestyle if they disappear tomorrow. For example, you can allocate money from your stock dividends, savings account interest, or even a small portion of your monthly side income. Treat crypto like your high-risk, high-reward bucket. Most experts suggest keeping it at 5 to 10% of your overall portfolio. This way, even if the worst happens, your long-term financial stability remains intact. By sticking to this rule, you'll avoid panic selling during crashes because your essential life expenses aren't on the line. And when you can hold with peace of mind, you give yourself the best chance to ride the next cycle up. Leverage is the silent killer in crypto. Even seasoned traders get wrecked when they borrow money to chase bigger gains. Here's why. Crypto is already volatile. Bitcoin can swing 10 to 20% in a single day, and altcoins can drop 50% in a week. If you're on 10x leverage, even a 10% move against you wipes out your entire position. In fact, according to data from CoinGlass, during sharp market drops, billions of dollars in leveraged positions get liquidated in just 24 hours, wiping out both beginners and professionals alike. Instead of leverage, build your gains a safer way. Dollar cost average. DCA by small amounts regularly over time. Hold spot crypto only. No borrowing, no margin, no futures. Think long term. For 10 years, not 4 hours. The truth is, almost every millionaire in crypto got there by holding spot positions through multiple cycles, not by trading on 50x leverage. If you avoid leverage completely, you're already eliminating one of the biggest risks in the market. Not all crypto is created equal. If you want to survive the long run, focus only on projects that provide real-world utility, tokens that solve problems, not just generate hype. Take Bitcoin. It's the most secure decentralized money ever created, with over $1 trillion in market cap during peak cycles and adoption by institutions, governments, and even listed on ETFs. Look at Ethereum. It powers smart contracts, DeFi, NFTs, and has processed over 1.5 billion transactions on-chain. Or Solana, handling tens of millions of daily transactions at low cost. It's becoming the backbone for high-speed applications. When evaluating utility, ask yourself, does this token actually solve a problem? Is there strong developer activity? Check GitHub commits or on-chain metrics. Are businesses, users, or even governments adopting it? Is there real economic value being transacted? Data shows that over 90% of tokens from past bull runs have already died or become irrelevant. The survivors were the ones with genuine utility. By sticking with utility-driven crypto, you drastically reduce the odds of losing money long-term. Meme coins may look fun and tempting, but they're one of the fastest ways to lose money in crypto. Yes, they can skyrocket overnight, but they can also collapse just as quickly, leaving millions of investors holding worthless tokens. For example, Dogecoin pumped over 20,000% from 2017 to 2021, but has also seen drawdowns of 90% or more multiple times. Shiba Inu hit the headlines in 2021, creating overnight millionaires, but within a year, it lost more than 80% of its value. Why does this happen? Meme coins rely purely on hype and social media trends. They usually have no real utility beyond speculation. Concentrated ownership. where a few whales control huge portions of supply. Pump and dump cycles, designed to trap retail investors. Instead of chasing memes, focus on projects that have clear utility payments, smart contracts, infrastructure, show sustainable user adoption, are backed by serious developers and communities. Remember this rule. Meme coins can make you rich only if you time it perfectly. But statistically, over 95% of retail traders who chase memes end up losing money. If your goal is long-term survival, avoiding meme coins altogether is one of the smartest moves you can make. Crypto rewards patience, not panic. If you zoom out, the data is clear. Holding for 4 years or more has historically been one of the safest strategies. Take Bitcoin as an example. In 2013, it crashed minus 83%, but by 2017 it reached new all-time highs. In 2017, it crashed minus 84%, but by 2021 it hit over 60,000 US dollars. In 2022, it crashed nearly minus 77%, but by 2024 it recovered again as adoption and ETF approvals drove demand. The pattern? Every 4-year cycle, tied to Bitcoin's having events, has seen new highs greater than the last. Long-term holders who simply waited to the downturns came out profitable. Ethereum shows the same trend. Early investors who held since 2016 have seen returns of over 100x, despite multiple 70 to 90% crashes along the way. Practical tips for this principle. Commit to a minimum 4-year holding window. Think in terms of cycles, not weeks. Use dollar cost averaging. DCA, buying small amounts regularly helps smooth out volatility. Don't overexpose yourself. If your holding period is long, you need the peace of mind that comes with using money you can afford to leave untouched. The reality is, almost no one loses money in crypto if they simply hold strong projects for 4+ years. The problem comes when people sell too early during crashes. In crypto, the news cycle is designed to play with your emotions, fear and greed. Headlines scream doom when prices crash and shout euphoria when prices rise, but neither extreme tells a full story. Look at the track record. Between 2013 and 2021, China banned Bitcoin more than 10 times. Yet, Bitcoin still went from under $200 to over $60,000. In 2022, during the collapse of Terra/Luna and FTX, the media declared crypto dead. But fast forward, Bitcoin ETFs were approved in the US in 2024, bringing billions in institutional inflows. In 2021, Elon Musk tweets alone could swing Dogecoin 30 to 40% in a single day. Following hype or panic headlines often means buying high and selling low. The data proves it. While short-term news causes sharp moves, long-term adoption keeps trending upward. Wallet addresses, developer activity, and institutional inflows continue to grow regardless of negative headlines. Practical steps to follow this principle. Don't trade based on headlines. By the time you see it, the market has already priced it in. Focus on fundamentals, adoption, on-chain activity, developer ecosystem. Remember cycles. Every bull run starts when news is at its worst and peaks when news is euphoric. So instead of being shaken by the headlines, train yourself to zoom out. News fades, but adoption and innovation drive the long-term trend. Hacking prices every hour only makes you emotional, and emotional investors sell at the worst times. Bitcoin, for example, had over a dozen 20% drops in 2017, but long-term holders still ended the year up more than 1,000%. Research shows investors who check their portfolios less often earn better returns. Instead of watching charts daily, set a schedule to check weekly or monthly and turn off notifications. Remember, short-term crashes look scary up close, but zoomed out, they're just bumps on a long-term upward trend. Volatility isn't your enemy. It's your ticket to big gains. Bitcoin often drops 50 to 70% in a year, yet over the last decade it's outperformed every other asset. Ethereum, too, has crashed multiple times, but long-term holders are still up more than 100x. Treat crashes as discounts. Zoom out to the 4-year cycle and stay calm. Volatility is simply the price you pay to be early in a revolutionary market. Buying is easy, but real success comes from knowing when to sell. Without an exit plan, fear and greed take over. Just like in 2017 and 2021, when most retail investors watch their profits vanish. Smart investors set price targets, sell gradually, or rebalance when crypto grows too big in their portfolio. Remember, taking profits isn't losing, it's securing your wins. The 10 principles of winning in crypto. First, understand what you buy. Study the project, team, and adoption. Second, use only spare money. Never risk rent or essentials. Third, never use leverage. Avoid instant liquidation. Fourth, focus on utility coins. Real-world use cases last. Fifth, avoid meme coins. Hype fades, value doesn't. Sixth, hold 4+ years. Cycles reward patience. Seventh, ignore the news. Headlines don't change fundamentals. Eight, don't check daily. Zoom out to see the big trend. Ninth, embrace volatility. It creates opportunity. 10, have an exit strategy. Take profits and secure your wins. If you found this helpful, hit the subscribe button, drop a like, and share your thoughts in the comments. Which principle do you follow the most?